Now, let's talk volume. What is volume? How do you use it as traders? These are the questions that you should be asking yourself as a trader. And taking into consideration that volume is one of the key factors influencing market dynamics. But first, let's start with liquidity before we can move to volume. Now, the question is, what's liquidity? Or what are the types of liquidity? And is liquidity important? If so, why is it so important? So let's dive in. In a formal setting, liquidity refers to the simplicity with which an asset can be bought or sold in the market without affecting its price. High liquidity indicates a healthy market with available buyers and sellers. And remember that for every buyer, there must be a seller willing to sell to the buyer, and vice versa. For every seller, there must be a buyer willing to buy from the seller. This is the only time I want to be in the market, and I would suggest that you guys do the same. Now let's talk about low liquidity, which indicates a little bit of difficulty getting rid of your positions, liquidating your own position in the market. So preferably, don't take trades during this time. I'm talking about when there's low liquidity. Now, we can move on to the types of liquidities. Now we have two types of liquidities. We've got what we call market liquidity. This refers to the ability to quickly execute trades in an active market. Then we're going to move on to the second one, which is funding liquidity, which relates to the availability of cash to facilitate transactions. Remember, every trade is a transaction between a buyer and a seller. Now we can move on to what? The importance of liquidity. Preferably, if you are to trade around times when there's high liquidity, because what will happen is you'll get much more efficient price. You'll enjoy it in reduction in unnecessary volatility or even noise. You will get better execution on your trades as well, or on your orders as a trader. Now we can move on to volume, of which here we'll be talking about volume analysis. The question is, what is volume? What types of indicators can you use for volume purposes? And the other thing is, what's the relationship between volume and price? Well, we're going to answer that. So at Veritas, we define volume as the number of shares or contracts traded within a specific time frame. It serves as an indicator of market activity. So basically what you can do with volume, you can actually measure the strength of a trend. It helps you and I as traders to confirm price trends or potential reversals. What I would urge you to do is read a book by a lady called Anna Cooley on volume price analysis. Some call the method volume spread analysis. It was an eye-opener for me when I read it. Yeah, that's about a decade ago, I think. Yeah, a decade. It's a really good book. So there's a few things that I consider when it comes to volume. Now, there's the first one that we'll be talking about is volume validating price. And the second one is volume and price anomalies. So what do we mean by this? Picture this. If volume is rising and price is rising, that's an uptrend. It's a strong uptrend. If volume is rising and price is dropping, that's a downtrend. A strong downtrend. This is what is called volume validating price. So volume and price are talking the same language. Now, when volume decreases and price rises, this indicates a weakness in trend to the upside. Secondly, if volume decreases and prices drops, that's an indication of trend weaknesses to the downside. This is what's called anomaly in volume price analysis. That's where price and volume are in contradiction. So they're not talking the same thing. You can use volume indicators like OBV, which stands for on balance volume, or use volume moving averages to assess the strength of price movement. Remember this, that high trading volume indicates stronger trends, while low volumes may signal consolidation or potential reversals. As a trader, you need to understand these relationships. But further studying, you have to consider these 4 events below. Okay? So, there's something called accumulation, which is consolidation before an uptrend in simple terms. There's something called distribution, which is consolidation before a downtrend. Both these consolidations happen to induce the retail side to buy before a downtrend and to sell heavily before an uptrend. You can simply identify them by looking at what volume does around your support or resistance line. So let's talk about accumulation. So during accumulation, what will happen is volume will shrink near your support line and expand near the resistance line. And during distribution, volume will shrink near your resistance line and expand near the support line. The other thing that you need to look out for are these 2 terms called selling climax and buy climax. So selling climax, that's a downtrend after distribution. Buying climax is an uptrend after accumulation. Now let's talk price action.